Every time I turn around, I am bombarded with messages to buy gold as a hedge against inflation. Whether it's G. Gordon Liddy rattling gold coins or advertisers on talk radio telling me I need to buy gold bars. And the fact that I can't drive down the road without coming across a sign that says, "We buy gold." The messages are 24/7, and I don't know about you, but they're very, very annoying. Now, there's no doubt that gold has had a run-up in the last number of months. But how do we determine if gold is truly a long-term hedge against inflation? I remember when inflation was running rampant in the early 1980s. Gold had reached over $800 an ounce. So let's take a look at what has happened since the early 1980s to today as far as the price of gold is concerned. As the chart shows, in January 1980, gold was selling for $850 per ounce. In the middle of June of this year, it was selling for $1,257 per ounce. The numbers have been rounded off to the nearest dollar. So therefore, in the 30 years plus, gold has had an annual return of a dismal 1.29%. And if we take an annual inflation rate of 3% over that same time period, it is very clear that gold was not a hedge against inflation. In fact, for gold to have kept up with an inflation rate of 3%, it should be selling today for $2,094 an ounce. The 1980 gold price was found on goldprice.com, and the price of gold on June 18, 2010 is from the Wall Street Journal. What investment did better than gold during this time period? One was the S&P 500. This chart shows that the Standard & Poor's 500 index in January 1980 was 106th, and on June 17, 2010, it was 1118. So the annualized return is 8.03%, a much better rate than an inflation rate of 3%, far exceeding the price and the gain in gold from 1980 through 2010. The S&P 500 figures were taken online from Yahoo Finance. A couple of points are in order. First, you cannot invest directly in the index. Second, if your portfolio consists only of a surrogate of the S&P 500, you do not have a truly diversified portfolio. And finally, past performance is no guarantee of future results. So in the time period we have looked at, we have seen that gold has not been a hedge against inflation. Gold does belong in your portfolio, but it should be as a result of buying companies that mine gold. Meanwhile, just enjoy your gold jewelry. Contact me or call me with any questions you have about this subject or any other.